Hi folks, Dick Moran here with Consumers First Mortgage, bringing you another Consumer's Moment. Thanks for tuning in. Pardon me while I refer to my notes. This is a fairly complex and relatively involved issue. QM and QRM, are those terms that you may have heard before, or maybe you're hearing them now in the various sources of industry news that you have? They stand for Qualified Mortgage and Qualified Residential Mortgage. And frankly, it's the next attack on home sales and home financing by our well-intended federal government. The intention is noble, however the consequences are going to be quite severe. QM, or Qualified Mortgages, create a standard or a set of underwriting guides that are intended to prevent the next meltdown in the mortgage industry. Lenders that maintain quality QM standards are provided a safe harbor should a loan that is QM certified go into foreclosure or default. There's no requirement for the lender to retain the 5% skin in the game, which is a component of the qualified residential mortgage. And without that 5% skin in the game, the lender feels far more comfortable making the loan. History has demonstrated, though, that when lenders have a safe harbor afforded them by guidelines, that rarely will they step beyond the guideline and make a loan. And when they do, frankly, they charge a fairly significant upcharge for the risk associated with making a non-qualified loan. Upcharge, more expensive lending. Does anything sound familiar? Maybe like, subprime loans? Here they come again, I fear. Some of the guidelines for a QM loan aren't very cumbersome at all. No interest only loans are allowed. No balloon loans. No maturities longer than 30 years. No prepayment penalties. No investment properties. And no piggyback seconds to make the transaction move more smoothly. Those are the easy ones. But how about a mandated 28-36 debt-to-income ratios? Those were prevalent in the early 1980s when I started in this business. Debt ratios, verified documentation of income, employment, assets, and credit. All loans have to be fully documented, in other words. The adjustable rate mortgages will have annual caps of no more than 2%, and the real biggie is no more than 3% of the closing costs. Total points and fees cannot exceed 3% of the loan amount. And the title and title insurance are part of that 3%, and my compensation and the bank's compensation are part of that 3%. So say goodbye to low rates, say goodbye to credit availability, and say goodbye to a lot of first-time home buyers, many second home buyers, and get ready for the qualified residential mortgage. That's something I'll cover in my next segment. This was just to wet your whistle. As usual, give a call if I can help in any way. I appreciate all the business you send to Consumers First Mortgage and me, and I'm available to answer your calls, your questions, and handle your customers' needs as they present themselves. Thanks again. We'll talk soon. Bye-bye.